You're listening to AI PRISM from Seoul Economic Daily.
Three structural stories from Korea's industry sector today, and each one has direct implications for global supply chains. Samsung Heavy Industries signed partnerships at two international events this week to lead the floating data center market, a segment Moody's expects to absorb up to $3 trillion in global investment by 2030. LG Electronics received its first S&P credit rating upgrade in 12 years, and Hyundai Motor is trying to push through a production overhaul backed by 20 new vehicle projects, while its union is pulling in the opposite direction. It's Thursday, June 4th. Let's take a look at a key development in Korea's industry sector. These three stories reflect a single pressure on Korean industry: the race to claim next-generation positions before competitors do, whether in AI infrastructure, consumer electronics, or automotive manufacturing. Start with Samsung Heavy Industries. The company is making an early bet on floating data centers, offshore structures built on ships or platforms that sit in rivers or at sea. The appeal? They sidestep the three biggest constraints facing conventional data centers: land scarcity, power access, and cooling capacity. At Posidonia 2026 in Athens, Samsung Heavy signed a three-party MOU with Greek shipping firm Capital and Lloyd's Register. Samsung Heavy handles construction, Capital handles project sourcing and investment, Lloyd's Register handles regulatory compliance. Separately, Samsung Heavy signed a joint development agreement with Supermicro, the US AI server maker, to validate AI server operations in marine environments, covering saltwater corrosion, humidity control, and position stabilization. The global AI data center market is one of the few segments with near-universal demand growth. Samsung Heavy is trying to be the company that builds the ships those data centers float on. Doosan Robotics is scaling its North American position through a different route: acquisition and local manufacturing. The company acquired U.S. robot software firm OneXia last September. OneXia's Pennsylvania facility is completing a capacity doubling this September. The order backlog stands at $13.5 million in Q1 2026, up from $3.9 million at end 2024. Doosan is also investing approximately $17 million to build a new collaborative robot factory adjacent to the OneXia site, both to capture demand and to reduce tariff exposure. North America's collaborative robot market is projected to grow from $600 million in 2025 to $3.1 billion by 2033, a 21% annual growth rate. LG Electronics is getting credit for a transformation that has been years in the making. S&P raised its rating from BBB to BBB+, the first upgrade in 12 years. The rating agency cited premium product strength, B2B segment expansion, WebOS platform monetization, and consistent debt reduction. S&P projects LG's debt-to-EBITDA ratio will fall from 1.6 times in 2025 to 1.0 times in 2027. Moody's made a similar move in January, raising LG to Ba1. For context, Korea Credit Rating also upgraded LG's outlook to positive last month. At Hyundai Motor, the picture is more complicated. The company briefed union leadership on plans for flexible production, allowing any model to be assembled across multiple lines based on demand rather than fixed line assignments. The driver: domestic sales fell 23.1% in May year-on-year to roughly 45,000 units, and Q1 operating profit dropped 30.8% to approximately $1.8 billion. The union's response has been to demand revocation of a 2019 agreement that already permits limited workforce flexibility. That agreement was specifically designed to manage headcount as automation increases. The union's push to undo it, citing job security, signals that labor management tension at Hyundai will be a recurring constraint on operational efficiency. For global industrial investors, Samsung Heavy's floating data center play is early stage but backed by the company's core competency in marine engineering. Doosan's U.S. manufacturing expansion is a replicable model for Korean midcaps navigating tariff risk. LG's credit upgrade reduces borrowing costs and signals institutional confidence in a non-semiconductor Korean industrial name. And Hyundai's labor challenge is a leading indicator. If the largest Korean automaker can't push through flexible production, structural output constraints will persist. Watch for the formal Hyundai union response this month. Watch for OneXia capacity completion and new order announcements in September. And watch for Samsung Heavy's first concrete FDC project announcement as a follow-up to the Posidonia MOU signings. That's today's AI PRISM Industry Daily. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI PRISM is a OneXia award-winning series. We'll be back tomorrow.
You've been listening to AI PRISM from Seoul Economic Daily.